All right, analysts are raising profit estimates for the first time since the credit market freeze 2 years ago. Wall Street firms are estimating the S&P 500 will earn more than $74 a share next year, up from $72.54 in May. Let's look at why with Bloomberg's Lynn Thomas. And Lynn, thanks for joining us.
Good to be here.
Why are we, first of all, seeing the analysts increase their forecasts? Had they just taken them down far too low to begin with?
Yeah, I think that's part of the issue. A lot of people have said they overshot the bottom, and then you're seeing this, surge of companies beating estimates. So analysts are kind of scrambling around saying, "Oh, we have to change everything real quick now."
Is the trend likely to continue? I mean, are analysts catching up now if they cut their expectations too much to begin with?
I think so. We looked at a J.P. Morgan report, and they showed, this usually happens in trends, and they thought that this is kind of the beginning of a larger trend, one that started sort of, when the credit market, sort of at the bottom of the stock market, and will continue for the rest of this, potentially bull market.
So, what does the turnaround tell you as far as what we're likely to see in the market? What is the speed of the turnaround, really, analyst estimates tell you?
I think it tells you that it's happening really fast. I mean, it's kind of mirrors what's going on in the stock market. You've seen this huge, change in the stock market, and everything's kind of gotten better really fast in the last couple of months. So.
Are you hearing any skepticism about the fact that we're seeing so many companies miss on the top line side and beat on the EPS side? I'm getting emails all the time from people about this. Ravi just writes in and says, why is the S&P going up when the revenues of most companies are coming down and profits are being met by cost cut reductions? And that's sort of a constant theme we've seen not only this earnings period, but the last one as well. Yeah,
and that's kind of that's the flip side to the argument. Why is the market rallying when, basically this is all done by cost cutting? That would be what a lot of the more skeptical investors that we talk to, that this is dependent on a lot of things going perfectly right, which may or may not happen.
I'm sure you're also hearing about, obviously, if people were too bearish before and had to change their estimates, they sort of overshot going down, they could overshot going up as well. Are you hearing that people are now going to raise too far, or is that not a concern?
Not at this point. I mean, everything got so bad, so it would take a while for that to sort of play out. But you do hear a lot of people talk about analyst estimates as being this sort of lagging indicator, like the unemployment rate, that analysts are listening to companies and making their decisions off of that. So in that sense, they're already kind of late to this.
Do you see companies really historically beating more than they miss? I mean, I know if you take a look at, for example, Goldman Sachs quarterly profits, analysts underestimated the profits, I think, 15 out of the last 16 quarters or 16 out of the last 17, and it just doesn't make any sense why they don't just add another 50% on,
My understanding was that usually companies beat, they try to engineer it so that they beat their estimates. But in this case, in the second quarter, you've had, more companies beat than on record, than Bloomberg has data.
So they always beat, but they haven't ever beat by this much.
Exactly.
Is really the bottom line. All right, thanks very much for joining us to talk about that. Bloomberg's Lynn Thomas.